Hey, good morning, everyone. Marty Mazur here. It is the 28th of June, 2024, with your weekly video update. I have to keep this one pretty quick given my schedule today and over the weekend, so I am indeed going to do that, but I'm going to make it, I think, very useful, hopefully instructive. And first of all, just scored our economic index and improved a little bit, -19, still in that area that says recession odds are too high to ignore going forward. Our base case that recession's coming in the next, let's say, 6 to 12 months. We try not to put timelines on things. We really prefer just to say that the risk is relatively high going forward and we should accommodate for that in portfolios. But despite the fact that we've had a couple of incremental improvements in places over the last couple of weeks, looks like the chances are actually increasing when you look at the leading data for something perhaps around the first quarter, first half of next year in terms of a true economic slowdown in the US. The areas that I wanted to just quickly get into with you is a little bit redundant. I'm sure I showed you this last time, but I just want those of you who are constantly thinking about stock markets and listening to the fact that the S&P is at all-time highs again or virtually there, I got to give you the underlying detail. So this display here in front of you, this is the S&P 500 cap-weighted index, and here we are virtually right at all-time highs, right? Folks, this green line is the same index. It's the S&P 500, but it just essentially equal weights everything in the index. Therefore, it gives you a better feel for the health of the overall market. In fact, let me do that right. If we take today's level and we move it backwards, we are precisely where we were all the way back to, call it, the end of February, so the first 2 months of the year. The overall stock market hasn't done anything. In fact, from March to now, it's actually down considerably, right? Half of its gains are gone, right? The Dow is the orange line, right? So that takes you about back to the same spot, right? Where that orange line ends there. The blue is the Russell 2000. 2,000 stocks, which make up much of the small cap universe. As you can see, actually, let's do this. As you can see, actually down up until just like a day or so ago, and it's up 0.5% on the year. So folks that are just giddy and thinking, or actually probably not giddy when they look at their statements, because if they're diversified into treasuries are actually down 3 or 4% this year. So this looks like a toppy market, not a market that's ready to take off to new and fabulous heights, but it could be. And I've talked about valuations, I've talked about technicals. Right now, all things considered that we can quantify, there's not a lot of upside and there's some risk of some serious downside. Doesn't mean the latter has to play out, just means that we have to be very cognizant of the risks right here. Wanted to show you consumer confidence. Both of the major measures showed their latest data. Conference boards, you can see where it sits. University of Michigan's, you can see it's rolling over. Still relatively high concerns about inflation going forward. I think the University of Michigan's outlook is in the 3 to 3.5% range from consumer expectations, which is a lot higher than the Fed's target. I could get into the weeds, but basically all you got to look at is the levels, and it suggests that the consumer isn't feeling great about his and her lot here currently. The PCE data came out today. In fact, I'll just read from my early morning notes. It showed nominal personal income beating expectations, so that's positive. Spending was off a bit, about 1/10 relative to expectations. Inflation came in at 2.6% right here, and that's as expected, and that's both for the headline and for the core, which X's out food and energy. Now, equities in particular, tech in particular, took the news constructively initially. A September rate cut is probably doable given this and the latest data. And that jives with our near-term view. I've said that I think the data is going to be rolling over, maybe at somewhat of an accelerated pace as we get into Q3. That's going to make the market maybe happy as it anticipates a Fed rate cut. Now, if the data gets the market's attention in the way I think it should, which suggests that recession risk is on the horizon, well, then we may not get much oomph out of the prospects for a September rate cut. And then I said it is interesting, however, that long-term treasuries and utilities were actually trading lower when I wrote that note, and gold was flat, while the weak data should actually put a bid under those, and the dollar was up a titch at the time. So now, as I speak, just to give you an update on that, gold has actually improved. It's up 1/3%, which isn't hurting our core allocation. Stocks are flat. The Dow is now back up 0.09%. It was actually down a few minutes ago. S&P is up about that, little less. It was down a few minutes ago. And the NASDAQ 100 was actually up I think it was up 0.5% to 1% earlier. It's flat as a pancake right now. So maybe the market is beginning to interpret this a little differently as we move on. And in terms of the U.S. sectors, communication stocks are down. Staples are down 1/3%. Staples should be doing better in a weakening economy, and I think probably will. Utilities are getting whacked, down 1.3%, which is very interesting because they're interest rate sensitive. And long-term bonds are down 1%. So if this data was tamer, why are the markets reacting the way they are? Quite the mixed up, jumbled, bifurcated market. Just started listening to this week's Macro Voices podcast. Bill Blaine, very sharp guy. And I just copied and pasted from the transcript the opening dialogue, which had my attention. And it's very consistent with how we think about things here at the moment. Eric Townsend, the host, said, Bill, it's great to get you. Let's start with the usual suspects. Boy, the S&P 500, so many smart people on this program make so many arguments for why it shouldn't be just melting straight up. But boy, that's what it keeps doing. His response, well, there's no stock market anymore, is there? All there is NVIDIA. And all the other stuff, and NVIDIA goes up 3% a day after falling 17% in the days before. It's a moment like this when I'm always reminded that global markets are not clever, they're not intelligent. They're just voting machines reflecting all the participants think. And if the participants don't have anything else to think about, and they make big mistakes, and they've got all the wrong things in their minds, then you get strange behaviors. Of course, the markets are never completely wrong, so you got to wonder what's behind it. And I rather suspect that it's a triumph of hope over reality. I've spent my whole career being a bond trader, watching bonds and bond markets. There is truth. I always consider that stock markets just kind of go off in the back of them. If interest rates are too low, then stock markets get too enthusiastic. And I think stock markets have missed the fact that global interest rates are now normalized at much higher levels and are not going back to the kind of nonsense 0 and 2% rates that we saw during the QE area. And I'm not sure that stock markets realize that. As I said, Bill Blaine is making a lot of sense to me. And folks, if you're clients who we talk to regularly, or if you've been reading and listening to my blogs, of course, you know that that's what we agree with currently, pretty much in terms of the overall sentiment. And at the end of the day, the market can keep melting up for a long time, but there's nothing fundamental that anybody who understands fundamentals should be remotely excited about right here. Okay, so with that said, I'm actually getting toward the end of it, folks. Wanted to show you this volume analysis that I've done for a long time. I just watched one of my favorite technical analysts illustrate, and I think I may have gotten this from him years ago because he looks at exactly the same thing. Randy Finney is his name. And basically it's the 10-day exponential moving average of the daily volume of the S&P 500, or the SPY, the S&P 500 ETF. Here we are, we get below this threshold, right? That's the red line there. And what it essentially does is it tends to denote lack of conviction, right, as the market tends to melt higher. Last time we had anything that looked like this actually looks worse, was right before that 35-ish% decline when COVID hit. And then you can see these mid to high single-digit corrections that happened almost every time we hit that level. And here we have kind of a cluster heading into the 22 bear market, where stocks went down, I think, 30%. Peak to trough, and we haven't touched it since then until now. Okay, so something to keep an eye on. Big moves, lack of conviction, unbalanced volume. I don't have the chart up, but it's actually on the S&P is showing much bigger volume on the down days of late than on the up days. So it seems to be more conviction on the sell side than on the buy side. And then lastly, let's just look at some inflation data. It came in favorable today, but when we look at it kind of across the ponds, if you will, the Baltic Dry Index tracks shipping costs across the world's oceans. You can see it's been going nowhere but up, choppy and noisy, but it's definitely moved up significantly back up to 2022 levels, right? But the one that really has my attention right here is the container index. So the WCI composite benchmark. You can see what's happening to container costs, right? So this is the cost of moving a container from here to there. When you look at it from China to the LA, which is a heavy traffic zone, my goodness, we're pushing up there and kind of threatening those highs when we had all those bottlenecks and so forth. So we're talking about inflation waning a bit, but if that's true and companies aren't able to price up and they're paying this much to get goods shipped, that's not a good sign for profit margins going forward. Nothing to lose any sleep over just yet, but when we look at the dozens and dozens and dozens of things that we look at, as I said in the written commentary, there's some things that just keep screaming at me from my charts, and as of this morning, this one has our attention as well. Folks, I want to thank you so much for watching and listening to these clients. I can't emphasize enough how important they are for you to get a handle on why we're doing what we're doing in our portfolios. And just to go back to where we started, reasonable returns for fully invested portfolios this year are somewhere between 0 and low single digits. This is not reasonable if you look at the froth that's in there, in my view, unless you're all there. In our core, we've been able to capture this or better if you have the full complement of our core with just 55% exposure. And that speaks to, other things that are doing pretty well that aren't in the equity market, and those would be found in the commodity space. We do have some fixed income exposure, and we have short-term treasuries in a money market fund earning about 5% annually. So we'll take it for now. Challenging market going forward. Opportunities globally galore in our view, but not something you want to get excited about just yet. This cycle has a bunch left to play out. And folks, this is just a time to be patient and very diversified. Thanks again. Hope you have a wonderful weekend. Talk to you next week. Bye-bye.